Welcome to China Tech Talk, a weekly discussion of technology and startups here in China. I am John Artman, editor-in-chief of technode.com. As always, I'm joined by Matthew Brennan, founder of China Channel. So this week we get Shai Oster, the Asia bureau chief for The Information, onto the show. I've known Shai for a little bit more than a year now. We first met face-to-face in Hong Kong. I have to say that he's a super interesting guy. And it's funny, Matt, because I think that, you and I have certainly been in China for a long time, but Shai is one of those people that has been here for a lot longer than we have, seen a lot more. And so his perspective is, because of that, much broader than both of ours.
Yeah, it's a good conversation that we have, Shai. I had some technical issues. Unfortunately, I wasn't able to participate or hear parts of it. But listening back to it, there's some gold in there for sure. And we mostly tried to keep it focused on Xiaomi and on the IPOs that are coming out of China. And we talk a lot of broad economic sort of background stuff about what's happening with why has this market got so frothy? What are the risks here? The differences between Hong Kong and the States for listing. Why are these companies listing? What do people need to be aware of? What are the factors driving all of this activity? I think there's some really, really good insights in there. The information is a very well respected source. Shai, as you've just mentioned, is got a long background in this area. He's speaking from a lot of experience.
Exactly, and I think that so he comes from Wall Street Journal and Bloomberg, and I think also what The Information is trying to do, it's very different than regular tech media. Almost every person that they have on staff, both in Asia and in Silicon Valley, they have more traditional journalist backgrounds, which I think is great for the tech media as an industry, because I think in some ways it's kind of showing that technology as a field of study, as a field of journalism, is really now is the time. And The Information certainly is a publication pioneering that. They're a digital first, digital only publication that is basically a startup, and so they in and of themselves are a type of technology company. If I remember correctly, they started an accelerator at some point late last year, looking at media startups and things like that. And so I think that Shai, because of working at The Information and then of course his own background, is able to bring a lot of insight and a lot of context. And I think that and really kind of going into some areas that we normally don't go into on the podcast. And so that's always quite nice to get a new fresh perspective. But with that, we bring you Shai Oster. Well, Shai, thank you so much for taking the time to join us today.
Thank you. My pleasure.
So one of the first questions that we like to ask all of our new guests is, what's your China story? Tell us who you are, what you're doing, and how you got there.
So I've been in and around Asia since 1998, when I first came over to polish propaganda for China Daily, the state-run English language newspaper. I'd previously been covering crime in small-town Western Massachusetts, so I was really perfectly equipped to show up in China. I did not speak any Mandarin. I had zero to little understanding of the history of China and modern politics, but it was an unbelievable experience back then. This is pre-Starbucks era, and just got the China bug. Really just loved it. And since then, I have worked as a freelancer, worked with the Wall Street Journal, and when we got our Pulitzer Prize, and was then at Bloomberg, and I've now been in Hong Kong for about 7 years. And 2 years ago, I joined The Information, which is a San Francisco-based technology newsletter, and we provide exclusive, in-depth news that you can't find anywhere else. And I opened our Hong Kong bureau, which is our first overseas bureau, and we've just grown. We've just announced that we've hired our fourth person here, so it's a big team. And we're really excited to be covering, I think, outside of the U.S., obviously Asia, and in particular China, is the biggest story in tech. It's the biggest story in all business and politics, really. And just as we say, tech is the lens. So you can kind of write about almost anything if you say it's tech.
Yeah, we're kind of in the same boat in a lot of ways with TechNode as well. Technology is a lens to understand and talk about some bigger issues. But I'm curious, and so Wall Street Journal to Bloomberg, and now to the Information. I mean, what was that transition like? Kind of working for these larger, more traditional publications, and then moving more towards this digital first, digital only, subscription based publication.
So to be honest, journalism is kind of the same wherever you do it. You pick up a phone and you ask a question and you write down the answer, and then you try to write a story about it. So I found that the actual job itself is kind of the same. I mean, what's hard for me is more wrapping my head around questions of technology and finance and understanding, what is a token, right? That's the challenging part, but the actual mechanics of it. And then in terms of the digital only, digital first, so it's actually, I find working at the Information very similar to working at the Wall Street Journal. Partly because a lot of us are Wall Street Journal refugees. Jessica Lesson, our founder, is ex-Wall Street Journal. Martin Piers is ex-Wall Street Journal. I'm ex-Wall Street Journal. Juro Osawa, my colleague, is ex-Wall Street Journal. So our corporate culture, or our reporting culture, is very Wall Street Journal driven in the way we sort of go for the big hitter stories. I like to think of it as we're trying to do page one Wall Street Journal stories every day, which is really, really hard. Bloomberg was different because Bloomberg. The other thing is that at the Wall, I always worked in smaller bureaus just as a way to. I find staying away from headquarters is always the safest place to be in my career. And so, the Wall Street Journal Beijing bureau is a relatively small operation. I worked for Dow Jones Newswires in London for a couple of years, and that's digital only. So I kind of had that experience. And Bloomberg itself has no print publication. It's essentially, the terminal, digital only, digital first. What was different about Bloomberg is it's a very large bureaucratic institution, and there was more of that institutional presence I felt at Bloomberg than I had at the Journal. I felt the Journal was very my bureau chief described it as trying to herd cats. All of us were kind of going in our own independent direction, whereas at Bloomberg there's much more of you follow marching orders culture, shall I say. It was a different experience. Much more of let's just leave it at that. It's a different experience for me. I had more culture shock at Bloomberg than I did coming to the Information. The Information felt great, and what I love about the Information is, for me, I've had this fantastic experience of building a team, which is the first time I've done that, and I've been incredibly lucky to have hired two phenomenal reporters, now three, Juro Osawa and Yunan Zhang, who are just killer journalists, just deeply sourced. Really just have a sense for what a story is. And so that's been really a pleasure. And also, as one thing that is definitely different at the startup level is that our feeling of like, we're all in this boat together, so let's make sure it doesn't sink. And so my job now, I also have to think in terms of the commercial viability of what we're doing. And so, I do a little bit of marketing, and I have to think about events a little bit. So it's a more diverse approach to the product, which is also fun and interesting. The interesting questions to think about. Because we're so small, we have a great degree of internal transparency, right? So, which is also nice. If you're at a big company, you can kind of feel like you're just a hired hand working for some big boss, whereas at a small startup, you're kind of it's more of a sense of solidarity on the team, and everybody's contribution matters to making a better product that you can all be proud of. I find it actually. The other thing that's interesting is that because so much has changed with tech, you can be a startup but have like world-class HR. In that, like, my expenses, doing expenses back in the day with Dow Jones or the Wall Street Journal or even Bloomberg is an unbelievable, cumbersome process. Now we just have an app, Spensify. Take a picture, upload it, boom, we're done. Right? Our HR management is an app, Gusto. Click, and you're done. So much of these legacy systems that were just a bureaucratic nightmare have now been appified, and so you can just focus on your core competency, which is like producing good stories. We do have an engineering team, and I can't really speak to that, but I do know that we do have to think about like, how do we, because our model isn't ad dependent, which is great. Some journalist had done a calculation on one of the profiles about us, because we're a subscription business. The revenue per story is the equivalent of like millions of hits you get off of an ad driven publication. So that really frees up the journalists and the editors from having to like do viral stories all the time. Now, granted, you always want your story to have the maximum visibility and the maximum impact, but it's a different, it's a fundamentally different dynamic, because we have that subscription model. And it's really interesting to see that like big stories will get like lots of subscribers, right? Because they'll see, wow. And that subscriber is committed to you, right? They really, if they felt that need to put down, our annual subscription is just around $400, they read your story, they thought, damn, this is worth $400. You're like, okay, we're doing the right thing. But we are, you have to think about like, how do you maximize your impact and your visibility? Also, what's really interesting is that we do get quoted a lot. We do get picked up. We got picked up in a Pentagon report, which ended up as part of a Politico story.
Interesting.
We certainly, when we break deals, yeah. So, we have impact, and it's amazing who our readers are. It's really, you were in our event in November here in Hong Kong. It was last fall in Hong Kong. We had Alibaba's number 2, Joe Tsai, who's a subscriber and a very avid reader. We have senior executives at all the major. It's interesting how much of an impact we have with the Chinese startups. So we did a profile of Wang Xing, the founder of Meituan Dianping. And the reason we were able to get that interview is because he reads us. So I don't know how he discovered us. I forgot to ask him that question, but he's a subscriber. So we're speaking to a pretty high level entrepreneur and investor. And, that's no shock in Silicon Valley. But what's interesting to me is to see how much of a penetration and impact and influence we have in the Chinese market, where, frankly, we've done hardly any marketing at all. And it's really just word of mouth and the impact of our stories.
So yeah, because you guys have been doing, China was, as you said, your second, your first, foreign overseas bureau. And I think that really does go to show, where your priorities lie. And I think it's really kind of cool, because, a lot of Silicon Valley, they're not really paying attention to China very much, and I'm continually surprised by how little attention is actually being paid to China from Silicon Valley. Of course, you're going to get attention to a lot of the big companies and some of the things that they're doing specifically in the States. But then in terms of actually being active and actively trying to become more involved in China, it's not as much as you would expect.
Which is ironic, because these guys, it's a dynamic that's changing. But in the past, it's been Silicon Valley money that picked the Chinese winners, right? If you were, the era going back to the early days of Alibaba, that, no Chinese financial institution was going to lend money to an internet startup China. Just, banks barely lend to private enterprises now, right? Let alone to something as crazy as the internet. And so there's actually so much Silicon Valley money, American private equity, Western private equity, that played such an instrumental role in the growth and development of the Chinese tech titans, that it's sort of surprising how, the guys who understand China really deeply understand China. But it's not, so you would think that would spread out organically to a broader, a wider swath of Silicon Valley. But there still is sort of this weird, blindered mentality. But on the other hand, a Chinese entrepreneur will know very well what's going on in Silicon Valley. So it's kind of interesting to see how the Chinese are very much aware of what's going on in Silicon Valley, and Silicon Valley still is kind of insular. But I expect that will change. The other thing that's interesting is there is this sort of a blindered mentality. But at the same time, so much of the top talent in Chinese and U.S. tech firms are kind of these bi-coastal people, right? Like, Lu Qi, the guy who just quit as COO of Baidu, he's was at Microsoft as a senior guy, right? So there's so much of this cross-fertilization in terms of capital and talent that it is still somewhat surprising to me how insular Silicon Valley can be.
So 2018 seems to be the year of the Chinese IPO. Why do you think so many companies are choosing to do so this year?
People want exits. if you have to look at the life cycle of an investment, I think, there's a natural 5 to 10 year horizon where people need to get their cash back. But also now is a good time to list. The markets are hot and everybody knows they're not going to last forever. There's what's called the window, right? So everybody's rushing to get their IPO in this window. And there's this constant sort of push and pull, right? The bankers are always trying to get a deal, right? The bankers make their money by getting companies to list, or the investment bank, right? So they're always going to be trying to pitch. And I guess you could call it fever pitch, haha, pun intended, right now, because, things look really, really hot, but there keep being these warning signs that this isn't going to last forever, right? Baidu's taking a hit, Tencent's taking a hit, a bunch of IPOs haven't gone as well as expected or hoped. So there's a little bit of a rising anxiety, which I think will even spur people to list even faster, right? Because you don't want to be listing into the down cycle. You want to be listing, you just want to get it to market. And it's partly because the purpose of listing has somewhat changed, right? You can raise so much capital privately. You don't necessarily list because you want more capital. You list, the factors driving a listing are things like, my investors need an exit. I need to keep my employees happy. They've worked so hard. They need to cash out. For Chinese companies, listing also offers lots of interesting opportunities. The money raised from the IPO is important, but also once you have your offshore entity in the form of the stocks, you have access to much cheaper capital because you can borrow much easily, right? If you want to borrow, if you're Xiaomi and you want, working capital loans, banks are going to be much more comfortable if they look at a listed company versus a privately held one, because there's a degree of certainty or that your numbers are accurate, right? Because you're not just lying to the bank, you'd be lying. There's SEC, there's oversight, there's regulatory, there's audits. And so borrowing as a listed company is cheaper. Also, your flexibility in what you can do. You can, maybe do M&A a lot more easily because you can use your stock itself to purchase and whatnot. So it just offers all sorts of interesting avenues, opens new avenues. But for sure, I think there's a sentiment that this is the peak and it's not going to last. And, just constant warning signs that this isn't going to be so hot forever. So a lot of people are rushing to seize this opportunity while they can.
So what do you think it is that's making this such a good window? Why is it so hot? I mean, is it just that money is looking for a place to land, or is it that Chinese companies themselves they're in a very good position inside the market to do something like this?
No, I think this is a global phenomenon, right? This is all about, this is a much bigger market phenomenon than just China or stocks. It's, the rally in the U.S. has kind of been going on and on and on. And despite the fears of, there's sort of this weird FOMO going on, fear of missing out. So I think people are afraid to sell. Broadly speaking, people are afraid to sell because you don't want to sell too early in what looks to be this continuing rally, right? The U.S. economy has been doing better than expected. And even though there's this constant warning signs about this trade war, is this trade war going to happen? Is the standoff with North Korea going to happen? No, it's going to be peace. And so there's this just sort of buoyancy. And I think, interest rates, the other thing that's still driving it is that, broadly speaking, there was just a lot of cheap capital in the form of all this quantitative easing, right? And it was just an unprecedented amount of liquidity in the markets that came from all this borrowing by central banks to prop up the economies back in after the financial crisis. And that's just kept interest rates at record lows for so long. And, if you're looking to make a buck, if you're a pension fund and you need to pay your retirees, where are you going to park your money, right? So you kind of, that's sort of, I think, one of the underlying factors behind this sort of global equity boom. What's interesting has been that private markets have raised more money than public markets. And so at some point there has to be a shift, right? Because if I've spoken to guys at like funds of funds, and they say, it's great that we're putting all this money into the private, venture capital, these late stage growth equity rounds, but you need to take the money off the table at some point. You need to get a return to pay off your limited partners, to pay off your pension funds, and so I think that could be driving. That's what's driving, to some extent, the push to list now, right? If you're a limited partner, you're like, look, this market's not going to last forever. We've had this great bull run. It's time to bring it out. And it's also cyclical, right? There's so much money going to the private markets and the private fundraisings. The pendulum sort of has to swing back to public markets. What's interesting is that the China tech scene, nowhere creates unicorns. It's U.S. number one, China number two. And the China market it's interesting because on the one hand, it's kind of reached saturation point, right? Smartphone sales for the first time are beginning to slow down, taper off, because really kind of anybody who's going to buy a smartphone sort of already has. And so for a long, long time, the China story was one of your untapped growth, right? Like, okay, phone penetration is 10%. So, as more people buy, whatever you do online is going to grow because, each new user represents new market potential, right? So that's now maxed out. But it turns out that within this market, it's such a vast market that the niches are kind of huge niches. So, this move into it's not just that you kind of think like, okay, Alibaba has e-commerce down and JD.com. Between them, what's left to do? Well, it turns out that you can do a really good business with sort of, Pinduoduo, which would be kind of like what? I don't know if this like Kmart online. It's sort of not like high-end goods, but like people love it because it's like, I don't know. I think of it as like Dollar General online, right? And that's a huge growth, right? And turns out that like, killing it in Shanghai is great, but you can also, if you start looking at second, third tier cities, because there's so many of them in China, you can have multi-billion-dollar businesses. And so that's kind of what sustained a lot of the tech growth. Is sort of this going deeper into the segments in the market. The other thing that's interesting is that the Chinese, just remember also that online commerce still represents only a small fraction of total commerce in China. Like retail is still overwhelmingly a bricks and mortar business in China. And so, that still represents a huge untapped market. That people are looking at, aging demographics also represent a growth opportunity, right? Because people are going to get sick, and so they're going to need to buy drugs and meet doctors. And we wrote a story about Hill House Capital. The superstar Chinese investors are now consolidating veterinarian clinics because when they started looking at aging, they're looking at aging as a investment thesis. They saw opportunity in pets because old people, especially in this post one-child policy, elderly tend to be alone, and so they're going to buy lots of animals and shower them with gifts and treats and want to take care of them and give them fancy medical care. So they're buying like hundreds and hundreds of pet hospitals. But sorry, that's a long way to say yes, that China still represents a huge opportunity. The other thing that's driving the Chinese story is the government's funding is insane, right? There's this, it used to be sort of the foreign Silicon Valley venture capitalists and foreign private equity who were investing in a lot of these companies, maybe a handful of domestic PE or VC firms. But that dynamic's really shifted, partly because of the huge rise of domestic wealth, right? There's literally thousands and thousands of family offices now all over China. And they're now getting into the tech space as well. And so that's a huge new source of domestic liquidity, whereas all these companies used to be primarily dependent on raising money overseas and, the idea of eventually listing overseas. Now, if you're a Chinese entrepreneur, you can tap this huge new surge of homegrown wealth to grow your business. And that also ultimately all that extra money drives all the valuations up. And that makes, as your valuations grow higher, everyone's like, it's this sort of potentially virtuous cycle. Valuations go up, investors get excited more, they want to invest more, and it kind of keeps going.
Yeah, and I think that's definitely something that we've seen quite a bit. I mean, especially recently. I think especially with the sharing economy craze of last year. Because I've been in China for a little bit less than you have, I would say, but I think some of these things that we are seeing are a bit cyclical. What we saw with the sharing economy and some of the ridiculousness of that, shared basketballs, shared umbrellas, and every color of bicycle that you could possibly think of. The issue, it reminded me a lot of Tuangou when Tuangou got really popular back in, and I can't remember exactly the dates, but that there was a lot of clones, there was a lot of different companies doing a lot of different things. It was very unregulated. Then with the sharing economy, it's a much more capital intensive industry, and yet there was still a lot of money pouring into it.
Yeah, and the copycat trend is not unique to the internet economy in China. Sanlitor, Bar Street in Beijing opened up with one bar, and then everybody poured into it. And it's part of the way that their financial incentives are built in the Chinese system. It kind of makes sense to copy, right? Because you're rewarded for copying. And in the sharing economy, let's call it the rental economy. There was actually a lot of sense to it. The financial models aren't as bad as you think, right? Because you're getting revenue from the beginning. Somebody's paying a deposit. So my company is getting cash coming in. And then what I'm getting, not only are you giving me cash, but you're giving me your details, your information. And one of the most important things in China is always customer acquisition, user acquisition. And user acquisition costs are actually really high in China, right? Because you always have to like essentially pay a tax to one of the gatekeepers, whether it's an app store or Baidu for advertising or Tencent or however you're bringing in traffic. It's very, very expensive. Someone's telling me it was actually as costly to acquire users in China as it would be in the United States. And these rental businesses were valuable because you're getting users who are actually paying you to use your product. So that's what was interesting, and that's why so many people were willing to put money on them, because the value isn't the business itself, but all the ancillary stuff. Once I have your name and your number, right? It's all about the funnel, right? Like this is all online advertising is all about how can I get as many emails and contact information as possible, barrage this person with ads and get them to buy some stuff. And the bigger the funnel, the more percentage of ads and successful sales I can make, right? So that's what was underlying this craze, is that actually the numbers aren't as crazy as you think, right? Like you are going to rent, okay, I'm going to do basketballs. You just paid me 5 kwai for that basketball. The basketball cost me 2 kwai. So even if you steal it, I'm still ahead, and I now know who you are, and I have an idea. I could now sell your information to the NBA or Nike basketball sneakers or whatever, right? So it's not such a like there is Chinese investors are actually incredibly savvy and smart, and when they're copying something, there's usually a logic behind it. You just have to scratch the surface to see what it might be.
So Xiaomi has chosen to go with Hong Kong for their IPO. Why is that? I mean, what are the considerations between doing an IPO in Hong Kong versus doing an IPO, let's say, in the United States?
It's funny because money is fungible, right? Like, and if you look at the guys in Hong Kong versus the top investors in the US, they're essentially the same, right? So it should be that there is no difference, but there is a difference in that the U.S. is predominantly institutional investors, and that means like a lot of people who are going to buy and hold. You're going to have less volatility. You're going to be dealing with a certain type of highly educated, highly technical, highly skilled investor, which can be great, right? For a lot of like the high growth internet companies who aren't profitable, it makes sense to list in the US because the Americans are used to understand that story. Like, because they know from Amazon, like if you can build that market, maybe one day you'll be able to be insanely profitable, right? So that's why a lot of companies still like the US. Plus, there's the dual shares and all that can allow founders to retain control of the company for better or worse when they list in the US. The problem is, if you're Alibaba and you're dealing with CalPERS or New Jersey's pension fund, they don't know what Taobao is. And if you show it to them, they won't understand it. They'll understand the Excel spreadsheet and the cash flow and, depreciation and all that, but they won't actually have a feel for what it is you actually do, right? I was talking to a very smart analyst, and I said, "Oh, do you ever use Taobao?" And he's like, "Well, no." And this is a guy who's based here. And I'm like, "Well, how can you ultimately decide whether you should buy or sell a product if you can't actually use it, right?" That said, Alibaba's stock doing phenomenally well, but I think at some point that's a question you want to ask. I think in Hong Kong, it's a very retail-driven market, which can work in your advantage because retail investors are very thematic. They're not going to be doing cash flow regression analysis. They're going to be like, Xiaomi, China, hot. Let's go into it, go crazy, right? It's very, what's the rumor? What's the word on the street? And so that can be very volatile, but can be very rewarding. Tencent has obviously done very, very well in this market. And actually, Tencent makes sense to do well because the local investors will really understand WeChat because they can open it up. They're probably using it. They see it, that all their friends, that all their relatives across the border in Shenzhen are using it. So they have a much more concrete understanding of what it is they're buying into. And the same is true for Xiaomi. For certainly, selling your stock in the US with a product that isn't really available there poses certain challenges that it doesn't pose here. There's also like simple things like allocation, right? Big funds have to allocate, and they have guidelines on what they can do, right? Oh, I have to do 10% Asia growth tech stocks and this percent. And so I'm sure there's a calculation of like, how do you position yourself to get maximum exposure to the big pools of money? Because a lot of people are going to have to buy into Xiaomi because it fits the parameters, right? That's why it was such a big deal when when companies become large enough to become part of the Hong Kong index, because a lot of funds just buy the index, and so your stock will get a bump once you get into the index, right? And so that's part of the calculation. I think the multiples here tend to be more attractive for some technology, but I think it's just sort of the familiarity of the product to the local investor, both the retail and the institutional guys, because even like the people at Goldman Sachs will just naturally have more of an understanding of what Xiaomi is just from walking down the street, and they see that their colleagues on the desk are using a Xiaomi battery pack or whatever. So there's reason for that. There's also the political optics of it. If you're going to be China's flagship smartphone company, wouldn't it be great to list in China, Greater China, right? And Hong Kong is China, so that's a lot of, you're scoring a lot of political points. So there's a patriotic element to it. I've always found it ironic that so many of that Alibaba is listed offshore, and most of its customers, most of the people who make Alibaba the billions of dollars that it does, can't participate in that upside because they can't easily buy shares in Alibaba stock because it's listed overseas and the capital is in place.
But I mean, but one of the reasons that Alibaba chose to list in the U.S. and not in Hong Kong was to do with the share structures. Like Hong Kong does not allow, or used to not allow, certain share classes, which is one of the reasons that Alibaba claims they decided to move to the U.S. Hong Kong has recently changed those regulations to allow those share classes. So, I mean, do you think that is a consideration for Xiaomi listing in Hong Kong as well?
Of
and
course.
also,
the changes definitely matter. The ability to, founders want to retain control of their companies after they list. And so the dual class share structure, where you kind of give sort of certain types of shares have super rights over others. So even if you own, I think, like, for example, how much does Jack Ma even own 5% of Alibaba, yet still, because he has like super shares, control the company? He has like the number of board seats he has. I forget the exact percentage of Ali that he owns. It's very small. It's surprisingly small. And so that certainly played a role. But so for Xiaomi, once Hong Kong changes that shares, the regulations, it's attractive to a company like Xiaomi. What was your follow-up question?
Yeah, but so then, if it is about patriotism, why aren't they listing in Shenzhen or Shanghai?
Because you can't. Right? If you're, think about it, right? So first of all, your investors invested in U.S. dollars. Your investors are all foreign investors, and they put in U.S. dollars. And so if you list in China, then they could only recoup their U.S. dollar investment in renminbi, and it's very difficult to get all that cash back out of the country, right? In some cases, that's worked, and people have done that, but it just doesn't make sense, right? If I'm, again, like, think of who the investors in Xiaomi are. They are all offshore, right? Because the company, there's some, I don't know where it is, Cayman Islands or whatever. And so that's why big Chinese tech companies, when they raise money from foreign investors, it's all dollar-denominated investment, and so your exit tends to be dollar-denominated, because it's just, what am I going to do with $1 billion renminbi? Well, maybe I have some purpose, but I'd rather have the choice of what I do with it, right? So that's why they have to list offshore. The other reason why it doesn't make sense to list onshore is because it's a regulated, doing an IPO in the mainland is not a question of whether the market and bankers will line up for you. It's whether the regulators will approve you, right? There's a waiting list, and it's a couple hundred companies long, and it's political, and there have been many cases where the people in charge of that system have gone to jail for corruption. And it's just, it's not a clean-cut process. That's why you see so many reverse mergers where companies will buy an already existing company on the market, in the domestic markets, because it's just a simpler process than actually going through the IPO process, because it just takes so long. There's so much uncertainty because, there's political considerations, policy considerations. There might be a period where the government wants everybody to list and wants to encourage it, but then it'll feel like, if there are too many IPOs and the markets start, there's too much liquidity, if there are too many IPOs, then maybe stock prices will get softer, and then it'll tighten up the spigot of IPOs, and then it'll loosen it. So it's just a lot of uncertainty, and it's an opaque system. So that's all. And that's another reason why people will just list offshore, because it's just kind of like, can you line up the bankers? Can you line up cornerstone investors? Can you tick all the boxes with the regulators? Good luck. It's not a political process. It's not a policy process. There's no one here who says, yes, you were allowed to list. It's kind of like, beyond are you a fraud? Obviously there's some scrutiny, but then it's not it's kind of like, if you can make it happen, great. If you can convince investors that I'm going to list my shoes and I can line up, $20 million worth of cornerstone investors and whatnot, then I'll list my shoes.
Right. Yeah. So the regulatory environment is very, very different. It's kind of the supervisory body that you might see in the SEC or in Hong Kong versus a process or a group of people who place politics above economics in many cases. But that also that brings us to CDRs. This is something that has got a lot of attention recently. Companies like Alibaba and Baidu are thinking about using CDRs to kind of relist, quote unquote, in China. Lei Jun has said that CDRs are a great policy innovation, and they're also expected to issue them as well. So can you just explain what exactly that is and why it's been getting so much attention?
So Chinese depository receipts are akin to American depository receipts, which is how some Chinese companies are listed in the U.S. And they are essentially, excuse me while I quote Investopedia for you. It's a certificate issued by a Chinese bank that represents a pool of foreign equity that's traded on a local exchange. So in other words, the thing you're trading in China isn't actual stock from the company, but it's something that a local bank has issued that correlates to the asset offshore. Does that make sense? Or it's sort of like you're using the bank as a mirror, if you will, for what's going on with the company offshore. So these are, it's a common type of, it's done all over the world. There are tons of Chinese companies that are listed through American depository receipts. And you can have, European companies do it in the US, whatnot. So it's not a Chinese innovation. This is kind of a widely accepted financial tool. It's great. I think it really makes a lot of sense because it gives you, as a Chinese company, the extra flexibility of, okay, now I can raise, the problem with there's always the capital controls are this constant challenge in China. If you bring in dollars onshore, if you want to take dollars out offshore, you're always going to need regulatory approval, and you never know if you're going to get it. Maybe one day you're allowed to buy soccer teams, and the next day you're not, right? One day buying a New York City's finest hotels is okay, the next day you're in jail. And so anything that allows a company to access both sides of the mark of that divide is a useful tool, right? Because Xiaomi had lots of operations onshore in China, and if it could just use its domestic IPO to fund those operations, it makes a lot of sense. It pays its bills in renminbi and in dollars, and so it has that flexibility. The other thing that it makes sense is that Chinese investors would love to get a piece of the real Chinese companies, because for better or worse, mostly for worse, Chinese domestic stock markets, because of this highly regulated and somewhat questionable IPO process, has a lot of dogs. Right, has a lot of companies that are super shady, and it's just kind of a carousel. Casino. And wouldn't it be great if I was a Chinese investor to not buy the hot pot company that announced yesterday it's becoming a cloud computing platform, but to buy a real business, right? And so that's great. And the Chinese economy needs the domestic stock markets to become more robust because it's going to rely on these stock performances to start paying out pensions.
Yeah. I think that it's the markets in China are a bit shady. I had a friend whose girlfriend used to work at, or his ex-girlfriend now used to work at a local trading firm, and there were many questions. There were many cases that he related to me of ethically questionable investments that she was encouraging him to make. And so I think that the market in general is not as trustworthy as you might want it to be if you were a retail investor or even if you're a bit more institutional. So looking at the company itself, this is what's always kind of so interesting. And so we've talked a little bit about IPOs and how it's kind of and some of the reasons for that. And it's not necessarily it's not 100% about the current company performance, but also quite a bit about the overall market situation. Because if you look at Xiaomi's revenue and if you look at their P&L right now, they're doing doing better, but they're also losing quite a bit of money. So what do you think is driving the revenue growth, and also why some of these big losses?
So they say so. What's driving the growth is India. They just killed it. They killed it in India. They're doing pretty well in Indonesia as well. So the growth is sort of, and they've recovered market share, substantial market share domestically as well. So the phones are doing, they had a rough patch with the phones, and they recovered. The losses, they say, are attributable to one-time, essentially it's a bookkeeping of how you account for convertible debt. So some people who bought, they're if you some of the investors they essentially bought into a bond that at one point will convert from a bond into equity, or some of it was preferred shares. So some shares it was preferred shares. So some of the shares that people bought, some of the equity that people bought pre-IPO has to be, because it's preferred shares, means that if the company goes bankrupt, they get preferred treatment when it's time to liquidate the assets. And so because of that special treatment, they're essentially on the books are accounted for as a debt. And so, they say it's a one-off and that it'll disappear after the IPO once all of that converts into shares, and that debt will become shares. And so that loss, it's merely just an accounting artifact. So they're, if you exclude that, they're doing okay, because that was merely a sort of an accounting practice. I'm more concerned with the story of the internet services, right? They sell themselves as like ecosystem that's not just, we're using the phone to acquire your information, and then we're going to make lots of money on selling you services. And that growth slowed down in China. And as far as I know, they're not really selling those services overseas. I think the Indian market loves a high-spec, solid-performing, cheap phone, but so far the value added in the services, as far as I know, hasn't taken off. And I think that's the challenge for them, is how do they take that ecosystem abroad? Because the ecosystem is how they get valuations. They don't want to be valued at hardware prices. They want to get valued at internet company prices. And that's, I think, the challenge for them.
Yeah, I got two questions about India, really. Things I've noticed. So within China, Xiaomi, I think it's easier for them to provide services because there's no Google Play. So if you buy a phone in China, you're going to be it's going to come preloaded with the Xiaomi store. But I'm unsure of how that dynamic would probably be much less stronger in India, where your default app store is going to be Google Play. So I've got a genuine question about that. That's my worry about that model in India. And then the sort of second one is like, are these phones that they're selling in India, I heard from one reliable source that they were actually selling them below cost price. And so I assumed that was part of the reason. When I heard that big loss, I was like, that makes sense, as well as why they would be losing a lot of money. Is that your understanding as well, Shai, that the phones they're selling in India right now, they're actually losing money on those just to gain market share, which is a legitimate strategy if they are. But it's a genuine question. I don't know if that is actually the case.
I don't know if that's the case. They claim that overall they have an operating profit on that on their smartphone business. So and I don't think they've broken out, as far as I've seen it. I haven't seen it broken out, India versus China. But even then they cap it, right? They say they're going to cap the profits at 5% forever. So those losses, I'm just trying to, hang on, I will find you the conversation. Yeah, it's preferred shares. So the loss was preferred shares, and it's a one-time accounting thing that should disappear. The specifics of the India market, I don't know. It wouldn't surprise me if they are, if you want to build market share, you take an aggressive approach to your price. But I don't know enough to comment knowledgeably about what's going on there.
The App Store thing, I think, is, I don't know, I got my feeling that's when they talk about making services on the phone, and that's where the monetization is happening, the App Store surely has to be the place where that's happening.
No, exactly. I agree. Yeah, that's totally.
That's China.
Yeah, that's and they talk up about like the brand loyalty and look how driven our fans are, and I have no way to gauge that. How deep is that loyalty? But yeah, it doesn't matter how loyal they are. If you're only ever going to be making 5% margin, that's okay. But yeah, it's sort of because one of the hardest things, I don't know of any Chinese company that has successfully sold. Okay, now I take it back. Cheetah Mobile has sold services, has a business that's providing services overseas, right? But what other companies have successfully sold their services overseas in the tech world? Who could we count? Right? WeChat? No. They've bought great overseas companies, but have they managed to launch WeChat in another country, right? Because if you're looking at because that's services are cultural, right? Hardware is sort of universal, but a service is very cultural specific. And I'm just off the top of my head, I'm just trying to think. I mean, if you guys can think of any tech companies that have managed to thrive selling services, okay, musically, arguably, but that's kind of sort of a foreign company in a way. Who else? Who would you guys think of that's done well selling
Yeah,
services?
well, when you say service, you mean like apps? Yeah, I mean the one that jumps to mind right now is ByteDance. I mean they're killing it outside China with TikTok right now.
There you go. Okay, I stand corrected.
Cheetah Mobile definitely. Yeah, I mean it's. You're right. Tencent with Dukes. That's they acquired that.
I mean, Alibaba hasn't even managed that, right? Is Alibaba strong anywhere outside of? Not really. They've bought into existing companies. So I don't know. I think the services model is really difficult.
In terms of apps outside China, we're starting to see that wave now with Musical.ly. With there's a company that's doing really well in Mexico, right, with a newsfeed app as well. Very recently, I think this wave is coming. But you're right. Up until recently, there's very few examples. Most of the developers are focusing on the domestic market, and WeChat would be one of the ones that you put forward as being successful outside China. It's kind of not.
Well, there you go. So maybe I'm wrong. Maybe now is the time for, a Chinese services to get really, really big. I mean, if TikTok points the way.
So I guess we're kind of running up on to an hour. I think there was one more question. So that I think that we wanted to ask, and that was specifically about high level management for Xiaomi. Do you think that it's as strong as it should be for a company of their very strong ambitions?
They had some shakeups. Was it a year or so ago when they were struggling on the supply chain? They had some issues there. And they've rejiggered their India team. I think they're pretty solid. And what's interesting about Lei Jun is he has such a chip on his shoulder about being huge, right? He's been around for so long and been through so much. Going back to the first wave of Chinese tech startups and Joyo and then Kingsoft, and so he's a veteran, right? He's really been around the block and he's been tried in a way many times, and so I think that makes him an especially resilient leader. He has an unusual amount of wisdom in a for a quote unquote startup. And so the guys around him, they seem pretty smart so far, right? They've managed to weather some pretty challenging disruptions, right? When Vivo and Oppo came up and with the Xiaomi model, you're going to go online only. Great. We're going to go like retail only, retail shops, right? And they just kind of blanketed every third tier city with their stores. And, in Southeast Asia, you see them everywhere as well. And then they quickly, they were able to respond to that, and recover from what could have been a crippling blow. So I've heard some people express a bit of concern, but I think the fact that they had the trough and recovered from it pretty quickly does speak to a level of grit and, as I said, resilience in the management team.
Well, great. So Shai, again, thank you so much for taking the time to join us.
Yeah, it was my pleasure. I hope you found it valuable.
Definitely. And so before we do go, just really quick, before we recorded this episode, I was looking on the information, and it was a bit difficult to find a recent byline of yours. So if people do want to find you, where should they do that?
Oh, I've been recruiting, and there's a piece coming out soon. So I'm moving into as management. I file less these days than I would like to. But you can reach me at shai@thein.nbsp.com. And I'm happy to, if you have any thoughts or questions, please ping me. Again, shai@thein.nbsp.com. And working on some longer term projects.
And to our listeners, if you enjoyed this episode, we'd really appreciate it if you left a review on iTunes. If you're on Pocket Cast or Overcast, you can tap on that star button, and it will recommend this episode to your network. If you want to get in touch with either Matt or I, you can find our contact information in the show notes. And in case you didn't know already, TechNode has a plethora of newsletters for your daily consumption. We do a daily briefing, which is a less than 3-minute curated summary of some of the biggest tech news stories in China that we did not cover directly. We also do the China Funding, which is a thrice weekly newsletter looking at some of the top fundings of the week. And as we go forward, of course, we're going to expand that selection. So if you want to subscribe, just go over to technode.com/newsletters.